Gold has had a fascinating year. On the one hand, when we look at the big picture, it's barely unchanged from the start of 2022, but it's had a number of forces that some may have expected gold to be trading significantly lower, such as the strength of the dollar, such as the Fed hiking rates at the fastest pace in decades. And on the other hand, concerns around the risk of recession and underperformance across the equity markets may have expected many to have gold performing at much higher levels, especially given with inflation at multi-decade highs. But gold, we think, has held up remarkably well, given what the macro headwinds were for gold and the pace of ETF outflows that we saw across the space. On the downside, it's been very well supported by price elastic physical demand. We've seen a rebound in demand from India and in China. But in terms of headwinds, we've seen acceleration in terms of ETF outflows. And until recently, speculative interest had been quite negative across the gold space as well. So we think that a number of the headwinds from 2022 are likely to persist in 2023, but some of those key factors are likely to recede, such as the dollar strength and the Fed hiking at such a fast pace.
Well, what explains the ETF outflows?
We think there's a dichotomy between retail investors and institutional investors. On the one hand, retail investor interest has been incredibly strong, whereas they've been concerned about the underperformance of equity markets and the concerns about risk and inflation being elevated. So coin sales have been very, very strong. But in terms of ETF flows, the focus has perhaps been more so on the pace that the Fed has been hiking at, or other central banks, such as the ECB as well. And concerns around the pace of hikes, perhaps triggered inflation, has weighed on ETF interest instead. And that's been a considerable drag for the gold market. But we think that pace of ETF outflows is likely to slow next year, so that main drag should recede as well.